Good evening. Yeah.
Yeah. So very nice to, have you all here, professors, and we are very, very delighted to host you. So, like, we are on time. So, with your permission, shall we start?
Yep.
Yeah. So, yeah, ladies and gentlemen, good evening to those joining us from India and Europe, and good morning to our participants from the United States and the other part of the world. My name is Shivam Srivastav, and I'm very, very delighted to welcome you to today's webinar. Our topic today is AI, crypto, and social algorithms in the future of finance. And this is an area that is changing fast and affecting how we think about money, markets, and technology. And as we all know, that artificial intelligence is now being used just for not just for efficiency, but to make decisions about credit, to test financial risks, and even to influence the market trends. And at the same time, the crypto markets are being shaped by social media and the new forms of digital money like stable coins and tokenized deposits are also raising questions for bank and regulators. So with these opportunities also, also it comes with the challenges. So can we think of like, should we trust AI systems that are accurate but hard to explain? Or do crypto markets create more chances for small investors, or do they favor large players? And if the data gets concentrated with a few big companies, how to, we sure that the innovation in finance is fair and accessible for everyone? To discuss these important issues, we are joined by a panel of distinguished experts who brings insights from finance, technology, and policy. And together they will help us to think not only the future of finance, but also like how we can make the future more balanced, inclusive, and responsible. So, before we dive into today's discussion, I would like to invite Mr. Venkatesh to introduce the aims and ongoing initiatives of CSITM.
Thank you, Shivam. Good morning, good afternoon, and good evening. I'm Venkatesh Balakrishnan. I manage the Center for Software and Information Technology Management of Indian Institute of Management. On behalf of Indian Institute of Management and the CSITM, I extend a warm welcome to the distinguished speakers of today and all the participants. Professor Shankadi Banerjee is the chairperson for the center. I would give a 1-minute introduction as usual. CSITM is IIM Bangalore's Center of Excellence in Digital Technology Management. We all know that Bangalore enjoys a locational advantage, and we are well connected with researchers, industry leaders, and lawmakers focused on digital technology management. And the goals of our center are aligned to promoting knowledge exchange, training, and research. We conduct various events. Some of them are in the form of webinars such as this, and some of them are larger events. As we speak, we are getting prepared for the next event of software product management, which we conduct every year. This will be a 2-day in-person seminar. And today's event, we are excited to invite Dr. Jagtiani from Federal Reserve Bank of Philadelphia, Dr. Niessner, who is a professor of finance from Indiana University, and Dr. Rao from University of Cambridge, who is also our alumnus, and many of our students, alum, and also people from the industry and the government are looking forward to the discussions of today. For all the participants, we are on LinkedIn, and we request all of you to follow us on social media and look forward to the communication from us. And also, we also encourage you all to engage with us for sustained contributions as speakers and also as volunteers for the various upcoming events. And we welcome you all once again. And with that, I hand it back to Shivam to take today's event forward. Thank you all and welcome.
Thank you so much, sir. It is my now pleasure and privilege to introduce our esteemed panelist. Our first panelist is Dr. Julapa Jagtiani, She is a senior economic advisor and economist at the Federal Bank of Philadelphia. She's also a central bank research fellow at the Bank for International Settlement and a fellow at the Wharton Financial Institutions Center. At the Philly Ed, Dr. Jagtiani has contributed to several important supervisory policy initiatives. Her research looks at the bank fintech partnership, the use of AI and alternative data in lending, and the broader regulatory and systematic impacts of cryptocurrency. She has published extensively in leading academic journals and plays a key role in organizing the Philadelphia Fed's well known, which is known as the annual FinTech Conference series. Dr. Jagtiani earned her PhD in finance and an MBA from the NYU Stern School of Business, where she was a Rockefeller Foundation Fellow. Our second panelist is Dr. Raghavendra Rao, who is Sir Evelyn D. Rothschild Professor of Finance at the Cambridge Judge Business School. He is also served as the Grisham Professor of Business at Grisham College and held the M. Chair of Financial Services at the University of Malay. Dr. Rao is the incoming president of the Financial Management Association. He is also the past president of European Finance Association and a former editor of Financial Management. He is also a founding director of the Cambridge Center for Alternative Finance and a member of Cambridge Corporate Governance Network. He serves on the editorial board of leading journals such as Management Science, the Journal of Corporate Finance, and the Journal of Banking and Finance. His research on corporate finance, governance, and financial innovation has been widely cited and often featured in the outlets like the New York Times, Financial Times, Wall Street Journal, and The Economist. We are very happy to say that Dr. Rao is also an alum of IIM Bangalore class of 1989, and he received the Distinguished Alum Awards for the IMB in 2022. He earned his undergraduate degree in chemistry from Delhi University and later completed his PhD at INSEAD. Our third panelist is Dr. Marina Niessner. She is an assistant professor of finance at Indiana's University's Kelley School of Business. And before joining Kelley, she was the Judith C. and William G. Bollinger Visiting Associate Professor of Finance at the Wharton School, the University of Pennsylvania. She also served as vice president on the global stock selection team at AQR Capital Management and as an assistant professor of finance at the Yale School of Management. Her research lies at the intersection of behavioral finance and emerging technologies, with a particular focus on fintech, artificial intelligence, and cryptocurrencies. Her recent work examines the impact of financial social media on market behavior, the spread of misinformation online, and the role of retail investors. Her research has been published in leading journals such as Journal of Finance, Journal of Financial Economics, Review of Financial Studies, and the Journal of Accounting Research. It has also been featured in the global media outlets, including the Financial Times and the Wall Street Journal. Dr. Niessner holds BA in Economics and Statistics and a PhD in Economics from the University of Chicago. So, once again, I warmly welcome all of you to this forum, and we are truly honored to have such a distinguished and diverse panels with us today. And let me briefly share the flow of the session. So, each panelist will speak for about 14 to 15 minutes, after which we will transition into a discussion. And towards the end, we will open the floor for audience questions. So, feel free to type in your question as and when they occur to you. The order of today's presentation will be Dr. Jalapa Jagtiani, followed by Dr. Raghavendra Rao, and then Dr. Marina Niessner. So without any further delay, it is my great pleasure to invite Dr. Jalapa Jagtiani to share her insights with us. Over to you, ma'am.
Good morning, everyone. Thank you very much. I see that there are 172 people joining. Thank you very much for having me today. And also, thank you everyone for joining us. I'm going to start sharing my screen. Okay. So what I'm going to talk about today is, so the topic is AI and crypto on the future of finance. So I will talk about a little bit about AI and alternative data, and also a little bit on the crypto role in the future of finance. So I don't think we need so much background for this group, so I'm just gonna skip a lot of it because of time constraint. So generally, we all know how with your center CTISM, this AI has play a role, and you probably hear a lot more about this from Raghu as well. Many applications of AI in finance so far. Fraud detection, credit risk assessment is one thing that I have been focusing on in my research, and all these other things, back office automation. So my research has been mostly focused on how AI could improve financial access to people who may, based on the traditional system, may be classified as non-prime. And so they would be unlikely to get access to credit because of their low credit score or short credit history. And so by using AI, which requires a lot of data to machine learning, so a lot of this data, big data, also includes non-traditional data that some countries have more regulation, more restricted as to what alternative data could be used. And different lenders also have their own secret sauce. They just use different models for, so that's why we see many different lenders that use through fintech, some of them, and some of them, they have their own model, their own proprietary data. Basically, it's utilizing AI to identify what we call the invisible prime borrowers, people who look like non-prime but are actually not risky. And so that's how AI has been enhancing credit access, moving us all towards a more inclusive financial system. Now, also through this fintech, a lot of people also have through fintech banking as a service, that they don't have a bank charter, but they actually can each open bank account for people, giving more credit, also giving faster access a few days before their paycheck actually clear. And there's no overdraft free. So set a new standard for the entire banking financial system, for a better service and more efficient for consumers. There have been concerns in using AI that possible the data may not be appropriate, the data may be outdated or may be biased, and they may be causing more bias than human making the decision. So I wanted to mention that there have been a study that shows that, in fact, both traditional lending and AI approach to lending actually are biased. But the AI lending, particularly for this paper that I'm listing here in the bottom, focusing on mortgage lending, and it's actually AI lending produces less bias than human lending. So, so now just wanted to cover briefly overview of what I have found. So I have looked at the use of AI along with alternative data, a lot of big data, impact on consumer loans, business loans, market loans, and also how it impacts when banks partner with the fintech partner, AI vendor, how it impacts the bank's behavior after their partnership, but also how it impacts the bank's default rate. To to confirm that they actually among non-prime loans that they issue, in addition to making more loans or granting larger loans to some non-prime borrowers, they actually default rate could also decline because they are able to accurately predict the default rate for these people with additional more data. They have a more holistic understanding of each individual. I'm not going to go through each of these in detail, but basically we covered all different types of loans using fintech data and some traditional mortgage HAMDA loan level data, small business loans from fintech, and also including bank stress test confidential data that banks report to the Federal Reserve, that we can see for each lending all the loans, billions of loan transactions, we can follow on a monthly basis whether there is a difference between loan that issued before partnership and after AI partnership with fintech vendors, and how it impacts the default using the stress test Y14 data. So this is just some picture to show how this is an older study that initially was published in 2019 that shows that there are some of the low score consumers, borrowers, that the blue one here, that are have low FICO score, less than 680. Some of them manage to be rated A or B. And when we look at their default rate, this is based on Lending Club data, older data before the COVID. We find that their default rate actually varies significantly among these non-prime borrowers, depending on the rating assigned by Lending Club using AI and more data. And their cost also has declined because they could use this to finance, to pay back their credit card loans, which is a lot higher rate. And this is basically the same conclusion, but using a small business lending data, joint paper with my colleagues from the BIS. So finally, the last one that I have been just came out, published on the Fed website. This is, as I said earlier, using a Y14 confidential stress test data to explore bank behavior. And as you know, CCAR data, we only have very large banks. Some of them have their own internal tech model that they have, but basically many of them actually partner with a lot of different AI vendors as well. And so we look at the different start date of the partnership and go back before and after to see for each partnership how they actually behavior changes in terms of lending to non-prime. Not going to go through all this detail. It's just best, and this shows that the pricing also changes because when there is no partnership, generally non-prime borrowers are all considered equally bad, and so they generally have to pay a higher rate. But after the partnership, basically, we could see that the pricing is more accurate because some non-prime defaulted and some don't default. You know, just like anything else, the default rate could go from 2% of super prime to maybe 50% among non-prime, but still there are 50 people of 100 people who would not default. And if we could identify these people, we can charge them lower rate, a lower price. And this is what we actually observe. Now I'm going to move on to the next topic, which is cryptocurrency, which is a big topic here in the US, at least right now. So we are basically, the entire landscape is changing in the US. And so I'm going to, in fact, yesterday there was a big conference in Wyoming, the blockchain symposium, that there's some new announcement for a stable coin. The Wyoming state actually just started issuing stable coins with their announcement yesterday. And also all these these cryptocurrency activities and stablecoin or blockchain activities previously was identified as novel activities that are subject to more closer supervision, closer more monitoring by regulators. And so Governor Bowman, who was also speaking yesterday at the blockchain conference, announced the sunset this novel activity program. So we are going to actually banks would be allowed to engage in these activities as well. So now, why crypto? So I'm going to talk a little bit about crypto stablecoin that, of course, we talk about financial inclusion, that AI could play a role in enhancing financial inclusion, but a lot of talk about crypto and stablecoin. One of the goals is also to help to enhance financial inclusion, because you don't need a bank account. You don't need to have a record, a long credit history, or even alternative data that would be used that I described earlier. As all you need is basically a cell phone, right? And so that's how you could engage in payment. You could be included as part of the payment system through this crypto. That's the idea. So far, as we have seen, that's what I should mention, that so far stablecoin or crypto have not been used for payment. It hasn't become mainstream. Stablecoin has been mostly used to support crypto trading activities. And also, the two goals for stablecoin so far. One is to basically to provide liquidity in the crypto ecosystem. When people, it's like cash in the crypto ecosystem, which is totally separate from the traditional financial system. And the second goal is actually for people who live in countries that have really high inflation, that they don't trust their own currencies, and they wanted to park their money in US dollar. And that's how they actually would access USDT or USDC, holding their wealth in stablecoin that is backed by US dollar. It has fixed value pegged to US dollar. No interest when you hold this stable coin. And in fact, you earn zero interest while the Tether, for example, issues stable coin, and they back this hold that reserve on the treasury securities. So they earn 4.5%, and they pay you no interest. And so they keep a lot of USDT Tether ends up making a lot of money providing this service. Now, so I have explained all this, I think. So I wanted to also mention that there are competing, besides stablecoin, which are going to become likely to become mainstream in the U.S. because we have this stablecoin Genius Act that is now going to be in effect in 18 months, and so many banks could now issue stablecoin. And we also have been hearing that there are some fintech that used to, this fintech partnership trend also is changing, because now we see, instead of just banking as a service, providing banking service, now we see stablecoin as a service at fintech, to partner with bank to allow smaller banks that don't have internal tech, in-house tech, to partner with this fintech in order to issue stablecoin. Now, why do want bank to issue stablecoin? Because they actually cannot make those loans. So it's 100% reserve requirement, unlike tokenized deposit, which is actually could be competing with stablecoin, because banks can basically achieve similar goal, but of course it doesn't help with so much as for financial inclusion, because you still have to have a bank account. But if you have a bank account already, banks could put your deposit on chain, so that it could basically, you can do whatever you want, just like you would do with cryptocurrencies or stable coins. It will move in real time, and it basically you don't need a bank to well, it's on the blockchain, but it's not permissionless blockchain. So it is going to have a lot of quality similar to stablecoin, but banks can still make loans because it is still fractional reserve. So that is could be a good competition. JP Morgan, for example, for quite a few years, you may have heard of JPM coin, which was a good example of stable coin that was issued by JP Morgan for wholesale transactions. So that is gone, actually. So Onyx platform that issue JPM coin is now converted to Kinexus, which is a new platform that is built on permissionless blockchain base that is owned by Coinbase. And that it is a tokenized deposit coin, JPMD, which is now going to be getting a lot of promotion in Asia. Actually, you probably see it in Singapore this November. So this is tokenized deposit. What we see so far is that some of the small banks may be interested in issuing stablecoin, but large banks may be more focused on tokenized deposits. That's what we see so far. There are some, as I said earlier, stablecoin is not supposed to pay interest, because if we think of it as a digital cash, our cash doesn't earn interest. Stablecoin should also not be earning any interest. But there are some the SEC approved stablecoin yield bearing stablecoin for Figure to issue something. So it could potentially be competing with tokenized money market mutual funds. So everything is going to be, sounds like everything will get moved to be on chain. We have money market mutual funds on chain, treasury securities on chain, deposit on chain, and of course all these other real world assets that you have heard before, generally like real estate, building, or whatever. So yes, tokenization is going to be big. I think I've already said all this earlier. How much time do I have? Let me see. I think I'm past the time, right? So I'm gonna just say quickly that my research on crypto, there are 3 projects. The one that I'm showing now is has already been published. We look at the roles of the different activities between the whales and the small retail investors. And so I'm just going to go quickly to show you that in general, I mean, this is not a new concept. We see in the traditional finance as well that the whales always have comparative advantage in the traditional stock market as well. But because this cryptocurrency market it's new, and it's not it doesn't have the guardrails, the same guardrails that we have in traditional securities trading. So there are more opportunities for the whales to take advantage. And so we find that evidence in this paper. Now, I'm just going to skip all this. And also, I wanted to mention 2 other papers that I'm working on that look at the impact of interest rate shock that maybe some starting to see, because we see that Bitcoin ETF and ETH ETF. Now, as you started to connect between the crypto ecosystem and the traditional financial system, right? Because now people can actually access directly, and they're traded in the traditional stock market. And so so we can see some lead lag interaction between the traditional market and cryptocurrency activities. Also, as you're going to probably hear a lot more from Marina, that social media alert and information from social media also has been affecting these transactions. And the whales tend to have more advantage because they have access to all these services that the little guys may not have access to. And so I'm just, these are just like a lot of these stocks are already moved on chain, have been tokenized. And I can't help it, but I wanted to promote this. Ragu is also a partner from Cambridge to actually organize this big conference, fintech conference coming in November. at the Philadelphia Fed. And this is basically a lot of these people you already know in fintech. They were actually speaking at our conference last year. We will have equally good speakers this year. That's all from me.
Yeah.
I'll stop sharing.
Yeah. Thank you, Dr. Jagtiani, for your very insightful presentation. You explained how AI and the fintech partnerships are making credit more accessible while also helping banks to improve their risk assessment. You also discussed the stable coins, tokenization, and the influence of crypto whales, showing how these are reshaping markets and raising new challenges for the regulators. So we truly appreciate the balanced perspective you shared on both the benefits and the risk of these innovation. And with that note, it is my pleasure to invite Professor Raghavendra Rao to share his thoughts. Over to you, sir.
Thank you very much, Shivam. So, and thank you, Jalapa. I'm trying to build on some of your comments in my talk, especially the ones which go back to the first part, which is talking about AI. Now, what I have to say is that I'm probably a little more skeptical than you in how, how effective AI is. But I'll show you exactly how AI models are actually written, how ChatGPT works, and why we should take it with a pinch of salt when we are trying to use it in finance. Right. So let's go back to the part which you brought up, which is essentially, we all talk about finance as a natural home for AI, right? If you think about data, about finance and insurance are the ones industry which have the largest amounts of data. So it's natural to say finance and insurance will be really impacted by AI. In contrast, accommodation, food services, not much scope for AI there because, not you can't replace human being interaction yet with AI. So as you go back, the idea in finance is very straightforward. It's all about predictive learning. Essentially, you have historical data, you take some predictive algorithms, you come up with a model. Then you have new data, apply to the model, make some predictions. This goes back forever. For example, back in 2010, there was a paper which looked at consumer credit risk models via machine learning algorithms. And so this was back in 2010, long before the current group of LLMs came around, right? But that hasn't changed. For example, you have this paper published in the Review of Financial Studies, which talks about, okay, how do you predict option returns using machine learning and big data? That has over 12 million observations, but they use big data to analyze whether option returns are predictable. Similarly, in December, there was a paper which looked at machine learning and fund characteristics to help select mutual funds with positive alpha. So all these papers have been using machine learning for a long time in the finance literature and in the real world. But what is interesting is that last year, a whole bunch of news articles very close together in time started becoming very interesting. For example, in July 2024, about a year ago, JP Morgan gave all their staff an AI-powered research analyst chatbot. And the idea was you're typing your research report away, and then you ask your chatbot, okay, tell me what tariffs Trump has put in today, and immediately give you the answer. You type it in, and you can do your report. July 2024. Right? 1 month later, there was an article which basically says, now I don't need the analyst to actually write the report. I can have ChatGPT write the report itself. So essentially, ChatGPT will collect the data, put out the data, and then boom, write a report in its own way. So 1 month later, September, and now you have a chatbot cleared to give buy and sell investment advice based in Israel. So it's called Bridget. You talk to Bridget. Bridget will recommend stocks for you to buy, and then it will say why you should buy those stocks. So essentially, it's totally fine to get investment advice from an AI model. All right. September again, 2024. Well, we know that Warren Buffett's pretty much retiring. He's not going to be around that much longer. But no worries, we have taken all his sayings forever, plugged it into a large language model, and you have your own personal Warren Buffett or David Tepper who will be giving you details about, how to invest in the style of Warren Buffett. All right. 1 month ago, July 2025. Now you have agentic AI, which is basically dig into the data for ideas, write the code for potential strategies, and test it on historic data. So it performs all the tasks of a hedge fund manager, with leaving no scope for human beings at all. So this is currently state of the art. Don't worry, in a month or two, I'll come up with new headlines that say even this is the past. So what changed? What changed a year ago which made it so amazingly popular to use AI models, right? As opposed to machine learning. What is the difference between machine learning and AI? Well, it turns out there are 3 types of systems which you can talk about. One are artificial narrow intelligence systems, which do one job and do it really well. But then we have a second one called artificial general intelligence, which is you train it in one area, but it uses the knowledge in that one area to make inferences in a different area. That's where the argument is right now. ANI models are well established. AGI models are not so well established. And then, of course, you have artificial superintelligence, which is, a computer starts to reprogram itself much faster than a human being can, and boom, within a day, human beings are obsolete. So what are large language models? Are they ANI or AGI? By the way, artificial superintelligence is still science fiction, right? It hasn't happened yet. They're still struggling about whether this is AGI, how far away are you from AGI, and what these models look like. Well, if you look at even GPT-4, which is primitive, now you have GPT-5, they are the 90th to 100th percentile in a huge range of exams we give our students. They do very well in even advanced placement exams, in art history, biology, calculus, English language, everything. They're even very good at wine tasting. So, for example, if you have the introductory sommelier exam, they are at the top of their field. Unfortunately, they don't get to drink the wine yet. That'd be one step too far, but they're very good with the theory of wine. All right. So how did this thing come about? Well, actually, the interesting part is most of the stuff is not very new. It goes back 60 years to 100 years ago. So a paper written by Mikulak and Pitts in 1943 basically talked about human beings as essentially electrical machines. Our brain works on electricity. Electrical signals are passing down axons of one neuron, pass over the dendrites axon to the next axon, and then so on, propagating through the brain. So how does that process work? Well, they said, imagine a picture like this one. If you look at this picture, you have 2 possibilities. One is you put yourself into the mind of the dog and say, oh, the dog looks really surprised. But then you are amused by the picture of the dog being surprised by a flower. That's second level thinking. But why are you amused? Well, they said, maybe there are a group of neurons here which get activated if the visual is funny. Those are getting activated now. There are other neurons which get activated if the text is funny. There's no text here, so those will not be activated. Maybe the other neurons that activate if speech is funny. Again, no neurons here, so those won't activate. But if the key idea is, if a sufficient number of neurons is activated, it crosses a threshold and you laugh. But this can be easily translated into a computer program. So the question is, should we go surfing? Right? And the answer, like a computer program, if the answer is 1, that means you should go. If it's 0, you should not. And let's keep a threshold value for that decision of 3. So what does that mean? Well, first you have to decide what is important to you when you go surfing. So possibly 1 would be, are the waves good? Waves are good? Yes, you should go surfing. Second, are there lots of people on the beach? If there are lots of people on the beach, it's not so much fun to surf. So if it's an empty beach, yes, otherwise, no. And finally, maybe you're worried about sharks. So has there been a recent shark attack? The answer is yes, you don't go surfing. If it's no, you go surfing. That's the basic step. Then you add some weights, right? And the weights are artificial. So for example, you would say X1 is 1 because the waves are really great. X2 is 0, so the crowds are out. X3 is 1 because there's no recent shark attack. But then the weights are 1 is 5, since large waves do not come around very often. W2 is 2, because you're used to the crowds. And W3 is 4, because you're really scared of shocks. What do you do then? Matrix multiplication. 1 times 5 plus 0 times 2 plus 1 times 4 minus the threshold value will give you 6. Right? 6 is bigger than 0, so the answer is we should go surfing. Very simple computer program consisting of 2 steps: weights and parameters. Multiply the two together, a matrix multiplied by another matrix. Look at the answer. If it's above a threshold, yes, otherwise no. That's the whole process. Okay, so let's take this to natural language processing. If you take this to natural language processing, the first one, which was actually created, was an algorithm called the word-to-vec algorithm. It was word to vector. That's the idea. And that happened in Gmail a very, very long time ago. That means 2015. 10 years ago is a super long time in these things. Right? Anyway, if you remember, at that time, when you're typing stuff into Gmail, it would automatically suggest the next word. How did it do that? Well, the idea is very simple. You just predict the context in which the word appears. For example, if the sentence is, the cat sat on the mat, the context for the word the is that cat sat on the mat. The appears in conjunction with cat sat on the mat. Cat appears in conjunction with the sat on the mat. Sat in conjunction with the cat on the mat, and so on. Right? You do this for lots and lots of words, you see where the contexts appear. And the beauty of the context is you can predict what each word is based on the context in which it appears. So for example, the good news is you can use this with mathematics. So let's take an example. Let's say something that happened in England a couple of years ago. Right? You had the vector representation for the word queen is 75. Man, 25. Woman, 28. So if you have the mathematical operation, 75 minus 28 plus 25, the answer is 72. The question is, what word does 72 correspond with? Immediately, we are saying queen minus woman plus man. The answer is a king. Right? And that's the idea. You have context means queen, king, earl, duke, all the royalty have context spaces around each other. Similarly, man, woman, child, human beings, context spaces close together. You can do a series of matrix operations to go from one matrix to the other matrix and spit out the corresponding number. Okay, but then the problem here becomes that as the sentences go longer and longer, it becomes more and more difficult to predict the next word. If it's a short word, it will take every word in the memory, figure out the context spaces, and keep checking the matrices till you figure out what the next word is. For example, the clouds are in the, what do you predict is the next word? The answer is obviously sky. But take a look at the second sentence. I grew up in a small house in Provence. I used to go to my grandmother to the local village and we'd buy baguettes and cheese. In the afternoon, I'd play boule with my friends. I speak fluent. Well, for a human being, that's easy. It's French. For a computer, the problem is, as the sentence becomes longer and longer, you change the matrix at the beginning of the sentence, which is giving you the context for the end. The gradient doesn't change very much. It's called the vanishing gradient problem. And essentially, it is almost impossible to predict what the next word is if a word is at the beginning, which is providing context for the word at the end of the sentence. But interestingly, if you pass this to ChatGPT, you say, same thing. What do you think ChatGPT would say? My prior was it would say French, but it didn't. It said, I speak fluent French, which I learned from my family and from attending school in the nearby town. I'm like, whoa, that was way more than I expected. I just expected to say French, and then it gave me all this additional stuff. So how did ChatGPT do this? The answer actually, again, goes back to 1948. And this was a paper written by Claude Shannon. It was called A Mathematical Theory of Communication. He was the father of information theory. And he described a way to construct ChatGPT without using a computer. The idea is very simple. The idea is that every language has a statistical structure. So for example, in English, you say the red house. The adjective comes before the noun. In French, it's the other way around. It's la maison rouge. It will never be la rouge maison. It doesn't make any sense, right? In English, you would never say the house red unless you're talking about wine. So the context itself is statistical structure is different in different languages, but it stays the same across the language. So what they did, what Shannon suggested was go to the library, start with a sentence. That's the word you're looking for. So pull a library book out, take a random page and find the first occurrence of the word the. Write the word down next to it. Maybe it's head. Now flip to the library book till you find the first occurrence of the word head. Write the word next to that and keep doing this until you get a sentence that looks like this. The head and in frontal attack on an English writer that the character of this point is therefore another method. Now, makes no sense. But grammatically, look at the last part. The character of this point is therefore another method. It's perfect English. May not make sense, but grammatically, it's flawless. So that's the idea. You keep running this using probability weighting, trying to find what's the next most likely word, give votes to the most, the best alternatives. You will end up with literally anything, which means at the end of the day, statistically, that's all it's doing. It is not looking for meaning. So for example, if you give the prompt, John is a boy, Jane is it will tell you girl. But if you type dealership, VIP, loser, girl, os, pioneers, girl, slut, it will give you girl. There's no need that it has to be English. The prompt need not be anything like a human being would type. We are attributing meaning to something which is a statistical package at the end of the day. Right? So you can go further. You can train on all the data that's available. How much data is available? Well, GPT-3 used Common Crawl, 45 terabytes of data. The GPT that they pulled it out from book corpus, Wikipedia, books, articles, and more. But it had only 175 billion parameters. With GPT-4, 45 gigabytes of training data, and the text data set was about 1 petabyte, which is 22 times larger than the entire collection of books in the Library of Congress. Well, GPT-1 had 117 million ways in which words could be connected. GPT-4 has over 1 trillion. GPT-5, we don't know yet, but it's probably well over 2 trillion parameters, all connecting to each other. So essentially, what you're doing is, Shivam mentioned that my chair at Cambridge was the Sir Evelyn Rothschild Professor of Finance. So I asked ChatGPT to complete this sentence. And ChatGPT said, okay, what I'm going to do is convert every word into a token, a number, because I can only do calculations on numbers. What is a token? Well, all the common words. For example, in this sentence, each word is a token. But then ChatGPT is several tokens because chat is a token, GP is a token, PT is a token. They're all words. So it will have multiple ways in which you chop these tokens up. GPT-4 can handle about 128,000 tokens at one go. Gemini can handle 1 million tokens at one go. That is the entire book of War and Peace. Plugged into Gemini, it will tell you everything from beginning to end. All right. And then it puts the tokens together in a meaning space. So for example, in this context here, the word pupil. What's the context space? All these words. The word school. What's the context space? All these words. Then it predicts the next word based on the context space. Feeds the next word in. Keeps doing this. It's called autoregression and keeps repeating until it finishes the sentence. That's the basic story. Unfortunately, and this is why I'm sort of disagreeing with Julapa, is that it makes mistakes. So for example, coming in here, this is literally what a GPT model is doing. So what you have over here, as you can see, is the sentence that starts with the word intelligence. And it'll say intelligence is I'm trying to slow it down, but it's moving really fast. But the point is, it will say, is the ability to acquire something. It's just picking the next most likely word of what that sentence should be. Now, interestingly, the problem here is that It doesn't actually understand intelligence. It's telling you statistically, this is the next word, and will keep going through this matrix of calculations. Well, coming back to what that means is it can go too far very easily. For example, if you look at the same thing and you say, well, let me talk about myself, right? Shivam mentioned that I had done an undergraduate degree in chemistry from Delhi University in India and a PhD from INSEAD. You pipe me into ChatGPT. ChatGPT will say, well, he's done his PhD in finance from MIT, where I've never been, and I did my BA in economics from from St. Stephen's in India, which is not where I did it. I did chemistry at Hindu in Delhi University. Why does it make that mistake? Well, again, statistically, what's most likely? My undergraduate degree is very unusual. I know only one other person who started with an undergraduate chemistry degree and gone on to do a PhD in finance. That's Joel Hasbrook in NYU. But apart from the two of us, I don't know anybody else who's done that. So it looks at chemistry. It looks at Cambridge, where I am now. But Cambridge, Massachusetts is a bigger context space than Cambridge, UK. So it says chemistry, Cambridge, Massachusetts, but he's teaching finance. So it gives me a degree in finance from MIT, even though I've never been there. But then it goes back and says, oh, he did his undergraduate degree in, he must have done in economics because he's teaching finance. It's much more probable economics to finance than chemistry to finance. But what's the best college in Delhi University for economics? It's St. Stephen's. So nicely, it gives me a degree from St. Stephen's College in Delhi University. All incorrect, but completely done because it's a statistical engine. It is not learning anything. So the models which are finish up, there are two groups of people. One group of people say, I'm talking to a human being. This is sentient. There's a human being there. And all of us have that impression. We are talking to a human being when we type in ChatGPT. I have students who text each other, and their text messages to each other, they will pass through Claude or ChatGPT or Gemini to help them compose the perfect breakup text message, for example. Unfortunately, my view is a little more of this type, which is, this is your machine learning system? Yeah. You pour the data into the big pile of linear algebra and collect the answers on the other side. What are the answers are wrong? Well, just stir the pile until they start looking right. Unfortunately, that's where we are. Right? We have gone through the equivalent of Searle's Chinese room, which was an thought experiment devised by a psychologist called Searle in 1970. And what he said was, you take a big room with one slot in the door, and you feed questions in Chinese into the slot. The guy inside the box, inside the room, he doesn't understand Chinese, but he has a book which translates the symbols which he sees on the paper and tells him what symbols to write after that. And he will give you the answer to your question. The question is, does the room understand Chinese? They're not actually doing anything. They're just taking the message, converting it, sending right back out. And this is what I worry when I see papers which talk about how AI models are helping solve, a lot of issues like discrimination and so on. I'm worried. What happens if the AI system is making a mistake, if it's hallucinating? And this happens more often than you think. How do you challenge an AI system? No one understands what's going on inside the black box. How do you control for type 1 and type 2 errors? That's my worry. And I can see a question on the chat which says, can you recommend AI tools to help select the appropriate mutual fund scheme? I'd be very worried about asking ChatGPT to give me an appropriate mutual fund scheme. And that's it.
Yeah, thank you, Professor Rao, for your sharing your very thoughtful insights and also bringing together the Delhi University concepts, because I'm also from Delhi University, and we had all these jive kind of thing, like which is the best in economics and in journalism and in English. Your research also highlights how AI is transforming areas like credit, compliance, and asset management, and at the same time, raise key concerns about explainability and the systematic risk. And your perspective on data concentration and the future of large language models, LLMs, also gave us, much to reflect on. So we appreciate the clarity and the depth you brought to these complex issues. And may I please request Dr. Marina Niessner to share her invaluable insights and expertise with us. Over to you, Dr. Niessner.
Okay, can you see this? Okay, perfect. So thank you very much for having me. So today I will talk about social media and finance, and sort of kind of take off from where Julapa going to mention social media. Oops, there we go. So why are we even talking about social media? And I probably don't have to motivate it too much, but obviously a lot of people, we all spend a lot of time on social media. And it's becoming more and more sort of not just a hobby, but also a news source for a lot of people. And now firms also use it to communicate with investors, for example. And then since 2021, after the GameStop episode, it's also it stopped being just a sideshow for financial markets and actually has started, like people saw that it can influence financial markets. And a lot of people sort of get their advice from social media, et cetera. And now there's been also growing academic literature that tries to understand various angles, how social media interacts with financial markets. And so what impact does social media have on financial markets? And there's sort of two sides to it. On the one hand, it obviously has drastically sped up increase the speed with which financial information gets incorporated or at least reaches individuals. And also in some ways it democratized the production of financial information. So instead of just journalists or analysts being able to provide information, now anybody can do that. But of course, on the other hand, there's a dark side to it where kind of misleading or false information can spread very easily and also very quickly. So while this is a pretty broad area, I'm going to focus on two kind of topics today. I'm going to briefly talk about kind of what information is there on social media, and particularly there are actually a lot of platforms nowadays. And how do they compare? Do we get sort of similar information from them? And then I will spend time talking about the second part, which is what information, kind of what is the quality of information on social media.
Marina, may I interrupt? There's some things on the chat, but basically saying your display is kind of shrunk a little bit. Is there a way to make it full screen? They can't read the stuff on your.
Thank you. Let me see.
Full screen? Is there a full screen version?
I thought I was doing full screen. Let me see whether this is oops, now it's not sharing. Continue to share. Is this better?
We cannot see your screen, ma'am.
Oh, okay. Sorry, 1 second.
Yeah.
I can't believe in this day and age I'm still.
This is perfect. Beautiful.
Okay, let me go back to where. Okay, perfect. Thank you. Thank you, Rao. Okay, so I'm going to briefly talk about information on social media, and then I will talk about kind of what is the potentially misleading or false information we're getting. So information on social media. I'm going to talk, and I have several papers in this piece now, but I wanted to highlight this one paper that's called The Social Signal. It's now came out in the Journal of Financial Economics. And the idea behind this paper is when we talk about social media, it is not just one thing. There are actually a lot of platforms, and there are just some of them. I know there are others, but so Stock Tweets is sort of platform specifically geared at conversations about stocks. And obviously there's X or Twitter. I guess now it's X. Seeking Alpha is a popular one. But they're all different. They're different in user population. They're different in sort of their layouts. They're different in timing. And so the question is, do we get similar or different information on these platforms? And how much information do we get if, for example, we use only one platform, which is commonly used in academic research? Often people don't have access to all of the data. But also, I know personal experience, often hedge funds might, for example, just acquire signals from one social media platforms. And also, how does it compare, for example, to traditional news? Is it just kind of spreading the news that we see in traditional media, or is it creating some new information? And they're basically sort of, you can think about it in two ways. On the one hand, maybe it's just sort of this monolith view. So maybe they're just substitutes. So it doesn't matter which one you get, you will basically get the similar signal or similar type of information out of it. Or maybe it's sort of this idiosyncratic view where, it's like big elephant, and if you just have one of the platforms, you will get either the trunk or the tail, but sort of to see the whole elephant, you need to look at multiple platforms. And obviously, there's a whole paper around it, but I'm just going to summarize our findings. So what we find is, so first of all, we're distinguishing two types of signals that you can get from social media. There's attention and sentiment. And you can think about sentiment, sort of, are people generally bullish or bearish on a particular stock? And attention, which is something that's actually very hard to measure with traditional media, is what type of stocks, what are the stocks that people are particularly focusing on at a given time? The reason it's hard to measure with traditional media, like Wall Street Journal is never going to publish 90 articles about Apple in one day. Whereas on social media, you can have these huge swings where people are focusing on this stocks or that stocks at any given time. And so what we find is that attention, what people are talking about, is actually common across these platforms. So when people are talking about Apple on Twitter, they're also usually talking about Apple or really focusing on Apple and other social media platforms. However, the sentiment signal seems to be idiosyncratic. So the sentiment signals are very lowly correlated across these different platforms. And we obviously made sure, we did a lot of analysis to make sure it's not driven by different NLP algorithms, et cetera. We also find heterogeneity in coverage. So small firms, for example, are much better covered on stock tweets than they are on Twitter or Seeking Alpha. So depending which stock you're interested in, there's also heterogeneity in that. And then interestingly, sentiment positively predicts future returns, even after we control for traditional media signals. So there seems to be some information in sentiment, whereas attention predicts negative returns, suggesting that there might be some herding going on that then people can overreact and then it reverts. And we might say, well, why are these differences, especially in sentiment? Why are there differences in sentiment across platforms? And what we actually show in the paper that platform features and user populations can affect this signal. For example, on stock tweets, there was increase in character limit at some point, how long a message can be. And that actually improved the predictive value of the signal for future returns, partially by drawing different users on the platform and also being able to provide more information in a given tweet. On the other hand, when GameStop happened, we know a lot of new investors, retail investors, flooded the market, and that actually increased the noise in the platforms across all platforms, especially for the new users. So all this. So to summarize, they're basically, again, and this is something prior literature hasn't done as much. There's a difference between attention and sentiment, and they aggregate differently across platforms. So sentiment is more idiosyncratic, attention is more common across platforms. That is partially due to different features, and there's also different information in the two systems. Okay, so that is sort of how information is different across different platforms. But then what is the quality of information that we're getting? And here I want to talk about two papers that I worked on. So one is called Celebrity Persuasion. And this is actually a big regulatory debate in the US right now. And it goes back to something that Jalapa talked about, which is cryptocurrencies. So where do people, and by people, I mean retail investors. That's something I've been very interested in my research. Where do retail investors get financial advice? Well, surveys show that when it comes to stocks, a lot of them actually get financial advice from financial advisors or maybe friends and family. And very few of them, at least historically, have been looking at social media. When it comes to cryptocurrencies, however, there are very few advisors that even, as far as I know, will talk about cryptocurrencies. And so a lot more people, for various reasons, also different demographics, turn to social media for their financial advice on cryptocurrencies. So the question is, what type of advice are they getting? And there's been one particular phenomenon that emerged. And here's an example. So this is actually an Instagram post or story. Are you guys into crypto? This is not financial advice, but sharing what my friends just told me about the Ethereum Max token, not the same as Ethereum, very different. A few minutes ago, Ethereum Max burned 400 trillion tokens, literally half of their admin wallet, giving back to the entire Emacs community. So this seems like financial advice, even though it says non-financial advice. So who said that? Well, it turns out it was Kim Kardashian. So what about it? Well, the Financial Conduct Authority called this the financial promotion with the single biggest audience reach in history. Why would they say that? Because Kim Kardashian has over 360 million followers on Instagram. You might say, well, so I know there are a lot of people in India, but this is like more than the US population, basically. You might say, well, it doesn't matter, right? Who in their right mind would follow advice from Kim Kardashian about finances? There was an SEC lawsuit. They didn't like that Kim Kardashian did this. And they conducted a survey around this. And it turns out, and I'll show you some other results from the survey, that 19% of respondents who heard about this promotion invested in Ethereum Max as a result. And if you look at the price history, that did not work out well for them. And there's been a lot of other class action lawsuits around this. Kim Kardashian is not the only one who's doing this. So we collect tweets by 52 sort of real world celebrities. What does it mean? These are people that you've heard about. So here are some examples: Gisele Bündchen, Justin Bieber, Mark Cuban, who might be, I mean, Mark Cuban is a bit of an exception, but most of them you've heard about not because they're some financial gurus. You know them from movies, etc. And their average number of followers is 15 million. Their median number is 2.6 million. So the question is, how do they affect crypto markets? So here are some examples of their tweets. Like Reese, I'm going to go quickly here. Reese Witherspoon just said, "Just bought my first Ethereum. Let's do this." Paris Hilton loves Bitcoin, etc. Okung is advertising Bitcoin as a collateral, makes credit score a thing of the past. I don't even know what that means. But so this is a very common phenomenon. And so first and this is mostly what I will show you, first we got a hold of the survey that the SEC conducted, or they outsourced to Morning Consult around this. And what they find, so this is, first of all, do you own crypto? And they surveyed 2,200 people that are representative of the US population. And they find that 17% say they own crypto, which is very consistent with general surveys of population. And the opinion of Kim Kardashian does not affect this, more of a sanity check. Men are more likely to own crypto, young people are more likely to own crypto, etc. The question was, did you see this Ethereum Max post by Kim Kardashian? So 18% that said they saw it, and in line with what we might expect, people who had a negative opinion of her were less likely to see it, and people who were positive were more likely to see it. And again, men saw it, were more likely to see it, younger people, etc. And then the important question is, of the people who saw it, the question was, did you invest? And again, this is the number that I showed you earlier. 19% said they invested. And again, men were more likely to invest. People who had a positive opinion of Kim Kardashian were more likely to invest. And this is a very small sample. By the time, there's only 399 people at this point. I'm not, just for time reasons, I'm not going to show you this, but we also have actual investment data from retail investors. And we only have it at the daily level, that on the day of the tweet, controlling for everything else you can think of, the investment into those crypto goes up by 14%. So we actually see real data, people investing in that, following this. And what happens to intraday volume? And I forgot to show you, well, for time reasons, these are large cryptos, by the way. This is Bitcoin, Ethereum, Doge, but these are not kind of toy coins where it's easy to move the volume. And we can see for high above median attention, so when people have a lot of followers or reshares, you can see on the hour of the tweet, this is not days, these are hours, the the volume in that coin spikes. It almost goes up by like 4 times. And then it stays up for a while and goes down. And again, this has every control you could have thought of. Whereas for low attention tweets, where people don't have many followers or there weren't many likes, you can see that there's almost no effect. So this has actual effects on the financial markets, on crypto markets. Quickly, and I might skip my last topic because I'm almost out of time. So then the question is, how do people perform if they actually follow this advice? So what we don't see here the individual trading data, but we can proxy for it. So on the x-axis, we show, did you buy before the tweet? And these are different hours, or did you buy following the tweet? And obviously, most retail investors are going to be in the following the tweet category, unless they were lucky or had some information. And this is how do you sell relative to the tweet. And I have another paper that shows that a median holding period for retail investors in crypto is about 2 weeks. And so what we find is red is bad, blue is good. If you buy before the tweet and then sell after the tweet, you actually make these, we'll talk about what the numbers are, but it's good. Whereas the further right you go, the later you buy, especially if you buy following the tweet, it becomes more negative. The returns are actually not horrible. It's also the question of what the counterfactual is. But if you buy before and sell after, you are actually pretty good. If you buy after and sell after, you still make slightly positive returns, but the transaction costs in cryptos are very large. And so by the time you take into account the transaction costs, these investors actually lose some money. On the other hand, you might say, well, cryptos have been just going up especially over the time period that we're looking at. So it's not hard. It's hard to lose money during that time. So what we look at, well, would they have been better off sort of just buying the market? And the market is Bitcoin and cryptocurrencies often. And they would have made more money had they just bought Bitcoin, or actually when it's Bitcoin, Ethereum, rather than investing in what celebrities had said. Just because I'm out of time, I'm going to stop here. And thank you very much for having me here. And I will stop sharing.
Yeah. Thank you, Dr. Niessner, for your presentation. We got to learn a lot. So you showed us like how social media shapes investor behavior through both attention and sentiment. And you also explained the influence of celebrities and the risks of fake or misleading financial news. And your work also highlights like how digital platforms can create both opportunities and vulnerabilities for the retail investors and market. We truly appreciate the practical lessons that you have shared with us. And if I may ask, let me begin with a question on one of a very important theme you discussed, which is celebrity influence in crypto. So you presented evidences that celebrity tweets can trigger sharp intraday spikes in trading volume, but often lead to a negative returns for their followers. And this seems to point to a systematic transfer of wealth from retail investors to early movers. So, in your views, is this mainly an issue of information asymmetry, or does it reflect deeper behavioral biases among the retail traders? And realistically, how might policy address such distortion without stifling open financial discourse online?
So this is a very good question. To your first question, I think this is a question more of information asymmetry, because if you're in the know and if you buy before the tweet happens, you will make very good money. And if you're not in the know, and even if there's no time, like even if you buy 10 seconds after, you may make some money, but on average, it's not a lot. So to your question about regulation, I think this is a very complicated topic. And obviously this has been, especially in this past year, kind of on regulators' mind. It's very tricky. I mean, we already have regulation in kind of traditional financial markets. You have to provide a lot of disclosures. I think, as far as I'm aware, you're not allowed to just advertise. you're definitely, and that was the issue with Kim Kardashian, and I think with some others. Some of them are being paid for this. So Kim Kardashian, that was the fine about. She didn't disclose a payment. So we already have regulation for that, and that should probably be stricter enforced. But more generally, I think the issue is that there are two new phenomena. There's the cryptocurrency market, which is not traditional, and it's not clear how to regulate it generally. And also there's social media, because if you think about financial advisors, maybe they have 100, 200 clients. None of them reach 316 million people. So this is a phenomenon that emerged with social media. And again, that is something that the regulators have to consider, because that is not a problem that we had as much before. So I definitely don't have answers for that, but I think these are very important questions that, and we're hoping to provide some evidence at least of that retail investors do follow this advice, because if they didn't, it's sort of a moot point, and that there's a potential for losing money. So hopefully the regulators can take it from here.
Yeah, thank you, Dr. Niessner. So, Dr. Rao, if I may ask you on the question on explainability versus accuracy. Your presentation suggests that AI is becoming essential to applications like credit scoring, stress testing, and regulatory compliance. But these models are often highly opaque. And in practice, regulators and financial institutions face a trade off between explainability and the predictive accuracy. So, should regulators accept black box models if they deliver systematic stability, or do you believe that transparency must remain a non negotiable principle in finance, even at the cost of reducing predictive powers?
My personal sense is that, it has to be explainable. If you're going to, the problem with just going for predictive power is the fact, if you do not understand why the model is giving you the answers it is, the question is, if the regime changes, will the answers change? You don't know this, right? For example, let me give you an example. Suppose you had trained an LLM and stopped in November of 2024. And then Trump takes over. Can you use a model trained up to 2024 to tell you anything about 2025? I mean, let me be honest. Even if you train an LLM model or anything up till today in 2025, you will not be able to predict what Trump is going to do tomorrow. Right? So my personal sense is it's better to have
Yeah.
explainability so that you can understand what is it that is driving the results, than to say, let's just focus on predictability, because we don't understand what the turning points are. And that's a big issue in finance and in economics. What happens when regimes change? What are we learning about the underlying mechanism? And I don't think we have that.
Yeah, thank you, Dr. Rao, for your insights. And let's move now to the lending and risk to Dr. Jagtiani. So, ma'am, your presentation suggests that when bank partners with the fintech AI vendors, they extend more credit to non-prime borrowers while default rates actually decline. So that seems to show that AI only broadens access, but also improves the credit quality. So, but some might argue that this could be a temporary effect and maybe due to a favorable cycle or selecting screening. This could, so how do you see AI-based screening as a structural improvement in risk assessment? And what would it take for regulators to treat these gains as durable rather than cynical?
Okay, thank you for this great question. So may I, if it's okay, I would like to, as a regulator, bank regulator, I would like to go back to the question that you asked earlier about the black box in lending using AI. I know that as a regulator, we actually do not just accept the black box. We understand the benefit of AI, but the standard that we require banks to meet doesn't change. Whether it is a lending is done in-house or is it done through a fintech platform. So the banks are expected to understand exactly what's inside the black box, And so as a regulator, we also review if the vendor is large enough. We also, talk about vendors like Visa, MasterCard, or Amazon, anything that is large that partner with banks, a lot of banks. They are part of our portfolio as well. We review them. So yes, we have to understand what's inside the black box. Also, in terms of, and as I said in the beginning of my presentation, that there isn't just one standard AI model that lenders use to identify this, what we call the invisible prime. PayPal has never asked anyone for a credit score, right? And they have their own payment, their own proprietary data. Google has its own data. There are a lot of different data aggregators that also have pick up on, on different things. And the lenders themselves also have different models, different secret sauce, I would say, right? Some models may be working better than the others, and also it depends on the environment, the situation, as you said. And first, I would whether it continues to work when the environment changes, it depends, right? I have looked at actually extended my research that I showed earlier, that it worked really well, so well. I extended Lending Club data to look at the COVID period, which if the loan was made in 2018 or 19 before COVID, and suddenly everything was shut down, hotel is closed, restaurants are closed. What happened to those loans? And of course, the impact varies significantly. Many of the fintech platforms actually went bankrupt. So Cabbage, for example, focusing on making small business loans, it now belongs to American Express. So Amex is using it, that platform, right? And but it's no longer Cabbage. And why? Because all the restaurants and hotels and all this, the dry cleaning, everyone's closed. So a lot of default. But that's different for different loans. Consumer loans may be less affected depending on your portfolio, depending on what you're doing. Upstart, for example, they said that their consumer model, lending model, includes some of this kind of stability measure. So you don't have to be rich. You can be like a bus driver, income not so large, but hey, it's more stable. So even during COVID, these guys are still working. They're still driving the bus, and so the impact of that model is it's less effective, obviously, because it totally changed. But there are some of the things that are still working. So when I look at my model, I could see that the impact of alternative data, which I assume that it is also, we don't know what the model is like. So we don't know whether this a big lift that we are seeing, whether it's AI or actually more data or better data. So I have to admit that I don't know if it is AI, but I still see a significant lift, even during COVID, that it is better than the traditional models that only look at FICO score and just traditional risk factors. There's still a lift, but the model keeps declining. And what the fintech companies actually was doing at that time was to make adjustment to their model. They didn't remodel the whole thing, but they do this overlay to, like, if you are a restaurant or you work at the hotel or something, there's some additional overlay adjustment to that traditional model, and it continued to work for a little bit. But of course, the model has to keep adjusting. The data changes, the nature changes. Yeah, it has to keep evolving because the data gets obsolete, right?
Yeah, thank you, Dr. Jagtiani. And so my next question is to for Dr. Niessner regarding, and if we can shift from risk to attention versus sentiment. So, and getting delving into deeper about like your research, which suggests that while social media sentiments predict the positive returns, attention actually predicts negative ones, and that seems very counterintuitive. since many investors often treat buzz and optimism as the same thing. So, could you explain why these forces diverge across platforms? For an example, if I may put like stock twist versus the Twitter, and how institutional investors should interpret these signals when using them in their trading models.
That's a great question. So, kind of to start at the end in terms of how one would use this information in their trading models, I think what it suggests is that if institutional investors wanted to trade on the attention signal, it would suffice. And again, having worked at a hedge fund, I know these signals are very expensive. So hedge funds are careful about which ones they buy, that it would actually suffice to buy a signal from one of these platforms to kind of have a good sense of attention. They're very highly correlated across platforms. However, if they wanted to trade on the sentiment signal, it would be helpful to actually obtain that signal from several platforms because they kind of complete each other. In terms of why does sentiment predict positive returns while attention predict negative returns? Of course, it's hard to know the true underlying reason. Our interpretation is that sentiments seems to be some information in sentiment, whereas attention looks a bit more like herding. And we actually we have a follow-up paper that I have not had time honestly to talk about, where instead of extracting signals about individual firms, we actually create a market level signal. So we actually purge firm information as much as we can. And for sentiment, we'll find a different result. So when individuals are bullish about the whole market, it actually predicts negative market returns. So it looks like there is information in the sentiment signal about individual firms, but for market, the sentiment is a lot more sort of anxiety or fear driven, and then there seems to be an overreaction that reverts.
Yeah, thank you, Dr. Marina, for your answer. And Dr. Rao, if I may ask to you about, you raised the question of whether large language models should still be seen as artificial narrow intelligence rather than a step toward general reasoning. However, in finance, where accuracy often matters more than true understanding, does that distinction really matters, or could heavy reliance on predictive but non-reasoning systems expose markets to systematic risk? For an example, like through herding effect or blind spot in stress testing?
Actually, that's a very, very good question. And in fact, I think Marina can speak to that as well, because
Yeah, we'll ask after that. Yeah, Prof. Go
one
ahead.
of the things that's happening right now is a lot of, and I think there was a question on the chat as well, that what do people do these days? They open up that thing and they say, "Hey, what should I invest in?" But what does ChatGPT tell you to invest in is basically based on the hype it's reading on Reddit and all these other things, which is recommending things like GameStop and all these memes. These guys buy those things, they go up in price, which means they talk more about it, which means ChatGPT is more likely to recommend it again. So, what is the link between social media and AI? I think that's a fascinating question. So, and I'm sure there's a paper in that somewhere. So, Marina, if you're interested, I think that is definitely a great paper. Right. And so the issue here is how much should we trust a model where the data itself is being generated by the model, which is being fed as an input to its own itself, right? Because when you type something, ChatGPT is using that information to train its models. But you're taking actions based on those results, which in turn is being used to make ChatGPT work better. At what point does this just become garbage? Fine. So that's a question which I've been struggling with, and I don't know what the answer to that question is.
Yeah, Dr. Marina, your take.
I mean, it's tricky. And my biggest concern when it comes to social media and And LLMs is the part that I didn't have time to talk about, I managed my time poorly, is a spread of fake information. So I have a line of research where I look at spread of fake information. And what we find there is when humans write it, while humans still have, other humans have trouble telling it apart from true information, there are actually methods how you can detect, because people's writing often changes when they tend to lie. But with LLMs, that obviously is no, that's not not a case anymore. And so what we find actually in that paper that when it comes to spread of fake information, what can help is make individuals aware. I know it sounds strange, but if you actually make it salient to individuals that there can be fraudulent information on these websites, they seem to at least temporarily take that into account when how much they trust information on social media. And I know in Europe, for example, when broker platforms advertise to retail investors, they have to disclose at the bottom what fraction of their clients lose money. So I think disclosure regulation might actually help with that, because otherwise it's sort of an arm race, right? Our tools to detect fraudulent information seem to always be lagging behind the innovations in the creation of fraudulent information.
Yeah, thank you, Dr. Niessner. So we'll just take few questions from the audience, and I can see that there are more than 40 questions, and if we would get more delve deeper, so we'll need another webinar. So, but I'll just keep one or two questions. So, Dr. Jagtiani, there's a question for you from S. Acharya. States that your research shows concerning concentration risk when financial institution widely adopt similar AI models. And in manufacturing environment where predictive maintenance and the quality control increasingly rely on AI, how can organization maintain operational resilience while avoiding the black box dependency trap that emerging in the financial services?
Sure, thank you. Yes, I saw that question. So I would do this. I'll answer this, but let me just also point out to what you just asked earlier about the social media. That I think what Marina and Raghu talk about actually point to the information asymmetry between large and small investors, because when we look at ChatGPT, it is a general AI model. It's not designed to actually give investment advice, but there are some platforms that actually specialize in analyzing social media data and maybe subscribed by the whales or some more wealthy individuals, and that actually gives you alert. So they can tell you when there's going to be a run in a bank or where where the activities are. I think that's more complete analysis than just ChatGPT, and that could be more useful. I hope Marina agreed. Now go back to as I said, regarding the interconnectedness. Yes, it has been talked about, and we are aware of it. First of all, lenders under regulators' supervision, they're not supposed to actually rely on the black box without understanding what's going on. But also, if there's some error, something hidden that is not found yet, and yes, if the same vendor partners with several banks, there could be interconnectedness issue, and it could impact financial stability. Just like the way we are concerned about the cloud, if the cloud just black out, then how many ATM machine will stop working, how many credit cards will stop working. It's the same. So yes, there'll be some false decisions that are made among many banks at the same time. But we try our best to not let that happen. But yes, there is a possibility.
Yeah, thank you, Dr. Jagtiani. There's another question, and I think Professor Rao, you can take it. Like we learned that LLMs generally work by next word prediction. So does it make sense to seek financial advice from LLMs by constraining the space from where it derives its response? So say only refer credible sources.
Well, the first problem is, as I think Marina pointed out, is what does credible mean? Right? So, yeah. So that's the issue here is It goes back, first of all, to the question of what is truth. And the second question is, this is a major problem that all of us have with LLMs. And I think I pointed this out in your paper too, Marina, which is the question is, you can tell the LLM, stop, don't take on the model beyond this point, but it can, right? I mean, it's been trained on that stuff. So the results which are coming from the model may not necessarily be, even if you're saying restrict yourself to this tiny little data set, the model, the parameters are coming from this much bigger data set. So it's very tough to do that. It's almost impossible.
Yeah, Dr. Marina, your take.
No, I definitely agree with that. And I know people are working on kind of trying to create models where you can artificially restrict your training sample. But I think generally in machine learning, right, when I joined the hedge fund in 2018, the sentiment was machine learning will going to put all of us out of business, right? And while it turned out that it's very easy for machine learning to predict whether the pictures of a cat or a dog, in finance, there's so much noise. So the noise to signal ratio is really, really high. So I mean, we saw that machine learning did a little of that, but definitely didn't put fund managers out of business. And I think it's TBD with LLMs, but based on prior experience, it's not super promising.
Yeah, and there's one question for Dr. Marina from Sakshi Jain. So she writes that Dr. Marina, as a research scholar, I wanted to ask how to motivate a new paper discussing the impact of social media on stock markets in response to an event.
Uh, that's a hard question, how to motivate papers generally. I mean, there's now it's probably a year or two old, but there was an Economist article where they quoted Cliff Asness, the founder of AQR Capital Management, saying that social media broke the financial market. So that's probably a decent way to motivate it. I don't think, I mean, obviously how to place a paper in academic literature is a very complicated topic I don't have time to talk about now. But I think we're actually at a point where, like before COVID, it was for me very hard to motivate anyone that social media mattered for financial markets. But I think that's sort of a mute point at this point. I think we know that it matters. So it's more about the quality of the question rather than motivation.
Yeah.
Answer here. Maybe I can just say, ask ChatGPT.
Yeah.
Good
Yes.
suggestion.
Yeah. So yeah, as we are running slightly over time, and I can see many more very interesting questions are into the chat box, but we won't be able to take any more questions. And thank you to all professors for your thoughtful engagement throughout today's session. This panel, Beyond Intuition, AI, Crypto, and Social Algorithms Shaping the Future of Finance, has brought together rich and practical insights on how digital technologies are reshaping financial systems. Dr. Julapa Jagtiani showed us how AI and fintech partnerships can expand access to credit while also raising an important question about the fairness, risk, and the evolving role of stablecoins and tokenized assets in global finance. Professor Raghvendra Rao reminded us of the power of and the limits of the AI in finance, highlighting the tension between explainability and accuracy, the risk of the data concentration, and the importance of governance adopting the large language models. Dr. Marina Niessner helped us to see how social media is influencing the financial market from the way attention and sentiment shapes returns. And she also talked about the impact of celebrity influence and the growing risks of misinformation in the digital spaces. So, together, these discussions made one thing very clear, that the future of finance is not just about the new technologies, but also about how we govern, regulate, and use them in ways that are transparent, inclusive, and trustworthy. So, on behalf of Center for Software and Information Technology Management at IIM Backdoor, I would like to extend my thanks to the panelists for sharing their expertise and our audience for their active participation. With that, may I now request Mr. Venkatesh to formally close this session?
Thanks, Shivam. Thanks, Dr. Jagtiani, Dr. Rao, and Dr. Niessner, and Shivam. Thanks a lot to you as well. As expected, the discussions were very interesting and relevant, especially in the Indian context. So India, as we all know, has ambitious plans in the fields of finance. And at the same time, the regulators are extremely cautious in adaptation of AI, crypto, and social algorithms. And in this, as we found the registrations, we had a lot of researchers, and at the same time, we also had participation from the government departments, and I'm sure they have a lot to take back. And we are going to have some follow-on questions and even requests for sharing the video on the link. And we definitely would look forward to all the panelists to be part of future events as well. And thanks once again, all the participants and panelists. It was indeed great, and we have seen a lot of participants, over 120, 130 at any given point, which was very good for considering that it is very late in the evening in India. Thank you all again.
Thank you so much,
Thank you.
Professor. Yeah.
Thank you.
Thank you. Bye. Bye.
Thank
Bye.
you for having us.
Yeah.
Thank you.
Thank you, ma'am. Thank you. Bye.
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 Bye.